Hello accounting analysts, viewers and subscribers, and welcome to today's video. Today we're looking at a topic that affects pretty much everyone: income taxes. As they say, there are two things in life that are certain: death and taxes. Since there is no way to escape, let's talk about it. Before I start though, let me say that this is not tax advice and the video is merely for educational purposes only. For tax advice, you would need to speak with a tax professional, as everybody's individual tax situation is different, and that personalized advice would be necessary. Let's get into it then. The Internal Revenue Service, or the IRS, as you might know, is a government agency responsible for collecting taxes and enforcing tax laws. The US individual income tax system is what is called a pay-as-you-go system, meaning that you pay taxes throughout the year as you earn your income. If you're employed by a company, taxes are taken out of your wages and your employers pay the taxes over to the IRS when the wages are paid. Non-wage earners, for example, self-employed persons or investors, are responsible for paying their own taxes when they earn their income. So these taxpayers are required to pay estimated taxes throughout the year, and the IRS charges a penalty if this payment is not done on time. Filing your income tax returns. Most people are required to file an individual income tax return. There are federal and state filing requirements. Things like income, filing status, and age determine your filing requirements. But generally, you must file a federal income tax return if your income is above certain thresholds established by the IRS and by tax laws. Your filing status has to do with whether you are married, single, or what the IRS calls head of household. This is someone who does not qualify to file as married and has a dependent. Generally, anyone who earns above certain income levels based on their filing status are required to file a tax return. For the 2023 tax year, which is required to be filed in 2024, the thresholds are as follows. 1. Single and under 65 years of age, 13,850. Single and 65 or older, 15,700. 3. Head of household and under 65 years of age, the threshold is 20,800. If you're head of household and 65 years or older, the threshold rises to 22,650. For those who are married filing jointly and both spouses are under 65, the threshold is 27,700. If you're married and filing jointly and one spouse is 65 or older, the threshold rises to 29,200. And the highest threshold of 30,700 is for those married filing jointly and both spouses are 65 or older. Now let's look at some common tax terms under the US tax code. First one we look at is earned income. This includes things like wages, salaries, tips from a job, and self-employment income from a business. Second, unearned income. Unearned income includes earnings like interest, dividends, capital gains, rental income, and royalty income. Third term is gross income. Your gross income is the total of all income before any tax deductions are allowed. 4. Adjusted gross income, or AGI. This is income minus certain adjustments allowed under the tax laws. 5. Your taxable income. This is a portion of income subject to tax after deductions. Tax liability. This is the total amount of tax a taxpayer owes. Let's look at filing status. What filing status is. So a taxpayer's filing status determines tax rates, deductions, and whether they're eligible for certain credits. And there are 5 filing statuses. First one is single. Unmarried or legally separated persons file as single. 2. Married filing jointly. Married couples who file a single tax return. 3. Married filing separately. These are married persons filing separate tax returns. 4. Head of household. Head of household are unmarried persons who pay more than half the cost of keeping up a home for a qualifying person, called a qualifying dependent. And 5. Qualifying widow or widower. Surviving spouses with a dependent child qualify for a widow or widower for 2 years after the year of the spouse's death. Now let's look into some basic information about the US tax system. The US uses a progressive tax system, meaning that as your income increases, your tax rates on additional income increase as well. There are two types of tax rates, and it's important to know the difference between the two. These are marginal and effective tax rates. The marginal tax rate is the rate at which your next dollar of income would be taxed. So if your next dollar of income takes you into a higher tax bracket, that next dollar will be taxed at that higher rate, and that's your marginal rate. The second rate is the effective tax rate. Now, the effective tax rate is simply the average rate at which your total income is taxed. The US income tax system has different tax brackets and rates, and we look at these rates for 2023. As I mentioned earlier, the US has a progressive tax system, meaning the tax rate increases as income increases. Your income is separated into different portions, with each portion taxed at a different rate. Each higher portion is taxed at a higher rate. So the more you earn, the higher each different component of your income is taxed. There are 7 tax brackets for the 2023 tax year, and they vary depending on your filing status. Okay, let's look at them now. So single filers, the first bracket 10%, $0 to $11,000. Second bracket 12%, $11,001 to $44,725. Third bracket 22%, $44,726 to $95,375. Fourth bracket 24%, $95,376 to $182,100. And the fifth bracket 32%, $182,101 to $231,250. Sixth bracket 35%, $231,251 to $578,125. And the seventh and final bracket 37% for single filers, that's $578,126 and above. So a single person earning that amount of money would pay 37% on anything above that threshold. For people married filing jointly, they have the same 7 brackets, but the amounts are different. For the first bracket, 10%, it's $0 to $22,000, 12%, $22,001 to $89,450. Third bracket, 22%, $89,451 to $197.50. Fourth bracket, 24%, $197.51 to $364,200. Fifth bracket, 32%, $364,201 to $462,500. Sixth bracket, 35%, $462,501 to $693,750. And the seventh and final bracket for married filing jointly at 37%, anything $693,751 and above. So married couples have a higher threshold at which they get taxed at the highest rate compared to a single filer. For people who are married filing separately, again 7 brackets, 10% to 37%. First bracket, $0 to $11,000. Second bracket, $11,001 to $44,725. Third bracket, 22%, $44,726 to $95,375. Fourth bracket, 24%, $95,376 to $182,100. Fifth bracket for married filing separately, it's $182,101 to $231,250. Sixth bracket at 35%, $231,251 to $346,875. And the final bracket at 37%, $346,876 and above. So married filing separately actually has the lowest amount for each threshold, making it the worst, basically the worst category to file under. You basically lose a lot of deductions, and it makes your tax situation pretty much the worst. So that's the filing status you probably would want to avoid the most. Head of household, the first bracket at 10%, $0 to $15,700. Second bracket 12%, $15,701 to $59,850. Third bracket $59,851 to $95,350. Fifth bracket at 32%, $182,101 to $231,250. The sixth bracket $231,251 to $578,100. And the seventh and final bracket $578,101 and above. So those are the tax brackets for the different filing statuses, and tax brackets are typically adjusted annually by the IRS for inflation. Let's now look at deductions. What are deductions? Deductions are amounts allowed under the tax code that reduce your taxable income and lower the amount of taxes you owe. And there are two main types of deductions: the standardized deduction and itemized deductions. Standard deductions and itemized deductions. The standard deduction is an amount set by the IRS that reduces your taxable income based on your filing status. The standard deduction varies by filing status, and for 2023 it is as follows. Single or married filing separately, $13,850. If you're married filing jointly or you're a qualifying widower, it's $27,700. If you are head of household, it's $20,800. For people who are 65 or older and blind, there's an additional deduction as well. To qualify for this age-based or blind deductions, the taxpayer must have turned 65 by the end of the tax year, or must be totally blind, or receive a letter from an eye doctor stating that the person sees less than 2200 in their better functioning eye, or their field of vision is 20 degrees or fewer. A person may also qualify for this deduction if contact lenses are able to correct the conditions, but they are unable to wear them because of pain or infection. The additional amount for these deductions are as follows. If you're a single or head of household and you're 65 or older or blind, you get an additional $1,850. If you're 65 or older and blind, you get an additional $3,700. And those were for people who file as head of household. If you're married filing jointly or separately and have a surviving spouse, it's as follows. 65 or older or blind, $1,500 per qualifying person. 65 or older and blind, $3,000 per qualifying person. There's also what is called a dependent qualifying deduction. For a person filing a tax return but is being claimed as a dependent by someone else, the standard deduction depends on their earned income. For the 2023 tax year, the deduction is either a flat $1,250 or the amount of earned income plus $400, but this cannot exceed the maximum standard deduction for that tax filing status. There are certain situations in which a taxpayer cannot take the standard deduction, and these are as follows. 1. If you are married filing separately and your spouse chooses to itemize, you must also itemize. If you are filing a trust, estate, or partnership return, you also cannot take the standard deduction. If you're filing a tax return that covers a period of less than a year, because of accounting period changes, you also cannot take the standard deduction. If you're considered a non-resident alien or dual status alien of the US, you're also not allowed the standard deduction. The second type of deduction is what we call itemized deductions. Instead of taking the standard deduction, a taxpayer can choose to itemize deductions, but you can't take both. It's one or the other. So if your itemized deductions are higher than the standard deduction, then it makes more sense to take the itemized deductions over the standard deductions, and vice versa. Some common itemized deductions include medical expenses. Any amount that exceeds 7.5% of your adjusted gross income can be taken as an itemized deduction. State and local taxes up to $10,000 is another popular one. Mortgage interest, charitable contributions, casualty and theft losses, only in federally declared disaster areas though. So those are some of the more popular itemized deductions that you can take on your tax return. Another type of deduction is what we call above the line deductions. These are deductions that reduce your adjusted gross income and can be taken even if the taxpayer does not itemize. So these are separate and apart from itemized deductions. And they include things like student loan interest, up to $2,500, individual retirement account contributions, your 401k, for example, self-employed health insurance premiums, alimony payments for divorces finalized before 2019. Those are some of what we consider above the line deductions. In addition to deductions, we have what are called tax credits. If you take a deduction, it reduces your income and you pay less taxes because you're being taxed at a lower income. But credits work differently from deduction. Credits directly reduce your tax liability, and therefore they are more valuable than deductions because they're reducing your taxes dollar for dollar, whereas deductions reduce your income and you get taxed at a lower income. And there are two types of tax credits: refundable credits and non-refundable credits. Refundable credits can give you a refund even if your tax liability is reduced to zero. Examples include the Earned Income Tax Credit, or EITC, and additional child tax credit. Another one is the American Opportunity Tax Credit, which is an education credit, and this is partially refundable. So the way refundable credits work, let's say for example you owe taxes of $100 and you got a refundable credit of $150. The refundable credit would cover the $100, so you wouldn't owe that $100, but you'll get back the additional $50 in the refundable credit. So that's how refundable credits work. Non-refundable credits now can only reduce your tax liability to zero. So in the example I just talked about, if you had a non-refundable credit of $150 and tax liability of $100, the non-refundable credit would only reduce your liability to zero, but you would not get back that additional $50. So that's the difference between a refundable credit and a non-refundable credit. And examples of non-refundable credit include child tax credit, adoption credit, retirement savings contributions credit, also called savers credit, and lifetime learning credit, which is also an educational credit. So those are some of the refundable and non-refundable credits that help to reduce your taxes and in some cases help you to get a refund. How to file your tax return. Form 1040 is the main individual income tax return form. Various schedules are used depending on your specific situation. For example, Schedule A if you're itemizing deductions, Schedule C if you have self-employment income. Some of the documents you will need to file your tax returns include W-2 wage forms from your employers. These are used to report wage income and taxes withheld by employers. 1099 forms for business or other types of income not reported on W-2. Some type of W-2 income include 1099. Some type of 1099 income include 1099 INT, which is interest income, 1099 DIV, dividend income, 1099 MISC, miscellaneous income, 1099 NEC, non-employee compensation, 1099 and 1099R for retirement income. Other documents you might need for your tax returns include receipts for deductible expenses, 1098 forms. These report mortgage interest you pay to a bank. 1095A or B or C, which report health insurance coverage information. And you need like your identification, like social security numbers or your driver's license to identify you and to file the tax return. There are several options for filing an income tax return. These include 1. E-filing, which is the quickest and most accurate method. You could paper file, you can mail your tax return to the IRS. Not the ideal way, but you can do it. You can use tax software such as TurboTax, H&R Block, etc. And you can also use professionals like a CPA or an enrolled agent to help you file your tax return. What about filing deadline? Well, the filing deadline for your individual income tax return is April 15th. Unless it falls on a weekend or holiday, then it becomes the next working day, but generally April 15th. And how do you pay your taxes? Well, if you're an employee, your employers will withhold taxes from each paycheck, which they then pay over to the IRS either monthly or semi-weekly. If you're a self-employed person or earned other income, then you're expected to make estimated taxes as you earn this income throughout the year. And the IRS does charge a penalty for not making estimated tax payments. So if you're earning other income, then you want to make those estimated tax payments and make them timely. What about if you owe the IRS? How do you pay? Well, again, there are several options to make payments to the IRS. For one, you could do direct pay from a bank account when you file your tax return. You just put your bank information in there and the payment is taken out. You could pay by credit or debit card. You can mail a check in. And if a situation arises where you can't pay in full, you can establish a payment plan with the IRS to make the payments over time. All right, the part that everyone likes the most, if you're one of the lucky ones, refunds. If you overpaid your taxes through withholding or estimated taxes, the IRS has to issue a refund for the amount you overpaid. And a lot of people look forward to getting a refund, but bear in mind that a refund is in essence an interest-free loan to the government. You're basically getting back what you overpaid. So you're not getting anything for free from the government. So bear that in mind when you celebrate your tax refund. Refunds typically can be issued by the IRS via direct deposit to your bank account. They can do a paper check, or if you think you're going to owe taxes next year, you would actually have it applied to the next year's taxes. But not many people actually do that, obviously. Okay, let's look at tax planning. So tax planning is when you use a tax code to legally minimize your taxes owed. Using a tax professional for planning is advisable to give you the best shot at minimizing your taxes. Don't try to go it alone. As this is a basic introduction to taxes, I will not be discussing tax planning in detail, but I'll just mention a couple of ways you can reduce your taxes. We'll do a tax planning video in the future. So a few ways you can minimize your taxes. First, maximize your retirement contributions in a 401k or individual retirement account. B, you can use tax advantage accounts like health savings account or HSAs for expenses, or 529 plans for educational purposes. You can also harvest tax losses in investment accounts. D, you can bunch itemized deductions in alternate years. And E, you can make charitable contributions directly from IRAs if you're over 70 and a half. As I said, I'm just mentioning these at a high level. In a future video, we'll take each of these and dig a little deeper into how to actually do them and talk about some other tax planning strategies. But just a few things to bear in mind that you can do now to minimize your taxes. Here are some common mistakes to avoid when you're doing your taxes. 1. Missing the filing deadline. If you miss the deadline, penalties and interest may apply. 2. Failing to report all your income. 3. Math errors. Using e-filing may help to prevent any mathematical errors. D. Using incorrect social security numbers. And E. Forgetting to sign and date the return. Dealing with the IRS. 1. Audits. The IRS audits a certain number of tax returns each year. Tax return may be selected for audit either randomly or if there are certain red flags in the return. Taxpayers who get earned income credit, for example, are typically audited at a higher rate than other taxpayers because of widespread abuse of this tax credit in the past. 2. Notices. The IRS may issue notices to taxpayers when there is an issue with their tax return. Notices include the following: CP 2000, proposed changes to your tax return, and CP14 balance due notice. C3. Payment plans. Taxpayers may establish a payment plan if they can't pay all their taxes due at once. Payment plan may be short-term, 120 days or less, or they can be long-term as well. I will touch briefly on state income taxes. Most states have their own income tax. Rates and rules vary. 7 states have no income taxes. These include Alaska, Florida, South Dakota, Nevada, Texas, Washington, and Wyoming. 2 states tax only dividend and interest income. These are New Hampshire and Tennessee. Understanding U.S. individual income tax is important to meet your tax obligations and for financial and retirement planning. This was a basic introduction to taxes. Tax laws are complex and change frequently, so always ensure you're getting the right professional advice to optimize your tax situation. When in doubt, consult a tax professional or the IRS website at irs.gov for the most up-to-date guidance. And just to remind you, this is for educational purposes only and should not be considered legal or tax advice. Tax laws are subject to change and your individual situation may vary significantly from others. This brings us to the end of the video. I hope you learned a lot from this video. Please remember to like, share, and subscribe. And I will see you in the next video.